So I thought that now's the time to get back at him and see what we can do. So I thought that this would be a good opportunity, Mark, for you to meet Adam. I know I've spoken a lot about him over the last couple of months, and for Adam to give you an idea of what we're doing, and hopefully something can come out of this. So I'll let you guys have a chat, and I'll just sit here and listen.
Okay. I'll go first. I'll kind of give you a little bit of brief description of myself. Chris introduced me a little bit to you. Basically, what happened was about 4 years ago, I was in the Marriott spa at the beach, and I was getting a workout and a sauna. And I'm in the sauna, and one of the gentlemen there that's in the club with me, it's it's one of the best Marriotts in the world. It's where all the workers from Marriott want to come to because it's like the beautiful beach, the beautiful place. And there was a guy in there. He asked me, "Hey, can I make websites?" Because he had heard that I did some websites. And I said, "Yeah, I've made a website or two." And he said, "Oh, okay. Well, we have some technology." I said, "Can you guys program?" "Yeah, we can program." So he asked me to take a look at his project. It happened to be this guy right here. So Ron has written 5 books, which you know a little bit about him. That's Ron there. The guy that I was talking to was from Keller Publishing. So he was Ron's publisher, and he asked me if we can make a website. So I went and saw the website. Based on his software. So basically they wanted their software that they've been employing for 15 years put onto the cloud. I said, okay. So me and my team looked at it. I've been with my tech team since 2005. So yeah, quite a while now. We've been together. We have a really good relationship. The head of that team is a savant genius. So we said, okay, we can do it. It'll be about $1 million. Okay. They looked at it and they said, okay. But Ron, who is about, 70 something, said, well, I'm a little bit old. I don't really want to run things. He said, why don't you run it? And why don't you just build it? And then we'll just give you a percentage and you can kind of run it too. And I said, well, how many of my customers come to me and say, I have the greatest idea in the world. And why don't you just build it for a percentage or something, which is like all of them, right? So basically what happened was I turned it around and I said, well, if your existing customers think it's so great, they'll pay the $1 million to have it done. So I put out one email. We raised, I think it was between 1 and 3 emails I sent out, and we raised half the money. So I stopped raising money because I strictly, I didn't want to give anything more away. I didn't really think that these customers were going to really respond like they did. So they responded very well to it. I didn't really know about it. I didn't really believe in it, to be honest with you, because I thought, yeah, sure, it's possible, but highly unlikely that, he can do these good percentages and he's got all this great tools. And I was very skeptical until the customers started, sending me checks. And then I said, oh, well, maybe there's some wings to this. And then we went through things, and we first started with the buy and sell signal algorithms. And we tested those buy and sell algorithms, and we tried to improve them with everything from REI to Fibonacci to all sorts of bullshit theories that people have. And we tested everything, and nothing improved them. So our buy and sell algorithms, we tested them. We back tested them for 4 years. We were able to get 4% above the S&P 500. Okay, so in my brain, I think, okay, wow, that's a product. Not really grasping the whole concept that, there's 500 stocks there. And if you pick the wrong stock at the wrong time, just because we're 4% above the S&P 500, that doesn't really mean that, unless we're in all 500 stocks, it's not really going to help us, right? Because if you're on those ones that are bringing the average down, so that's initially how we started selling the product. We launched as Wall Street Winning. We started selling the product that way. And then I slowly started to realize that the buy and sell algorithm was geared towards the options. because if you look at, I know Chris is giving you some demo of inside the actual website and how things work, but there's a sell at a gain, sell at a loss. And a lot of the numbers in the actual algorithms are also geared towards options to be the best with options. So essentially we then decided, okay, we've got to launch options. We launched options. Then when we launched the options, we still had a problem because now it's great. We have this algorithm, we have this option, but the problem is we can't sell it to my mom and dad. So I built this website for my mom and dad. My mom is a school teacher. My dad is a General Motors accountant from General Motors. In the .com crash, they gave their money to Merrill Lynch, and Merrill Lynch lost half of their money. So they took them from $1 million retirement to $500,000 retirement, and their broker still got paid. And I thought that was bullshit. So my goal was to create something that my parents could use. So I still failed at that because options are a very abstract opportunity. So they're great if you understand them and how to use them, but understanding how to use them is very challenging because you have to take gains now for things in the future, and you're constantly rolling and moving, and it's an ongoing process that most people don't grasp. So then we moved into something called Done For You, okay, where we were just picking. Basically, we were crunching the algorithms, and we moved into a product Done For You, where we do 1 trade setup a week for a basic, or we do 3 trade setups for a plus. And it was good. And, it helped people along a little bit further, but it wasn't far enough. And I had a lot of clients who had more money saying, well, do you have anything that you can just do it for us completely? Can you automate the process? So that's when Chris came together, where we started doing things on a pro, where we actually would take this data from the plus and we made it something called a pro. The pro was where there was more stocks. We were actually managing to $1 million. And we were going to do this for clients. So we started out with 2 test clients, and we kind of stopped there because of the simple fact that we were trying to go the route of, let's say, non-traditional and be more of a disruptor. We were even going the route of where we would automate the whole process and take the trader out of it and have the actual computer execute everything. The problem with that is there's some legal challenges, and the customers, when we are transparent with the customers, it doesn't really prove to be beneficial to us. It actually proves to be the opposite. So when what we found and our data has suggested, as transparent as we wanted to be with the customers, and we wanted to show them here's how we did it. We're doing 1% a week. We charge you a fee and we take money. Psychologically, the clients paying us a fee doesn't work well, as opposed to us taking a fee from the profits. Psychologically, allowing the customers to have access to their daily accounts, not proving that they can handle that. They kind of freak out. So we've had kind of a not the most positive experience. So we haven't been able to scale that. So we kind of went down the path and said, okay, everybody that we've talked to, my attorneys, all of my counsel said, well, it sounds like you guys have a hedge fund here, not an actual, the way you're doing it, automating it, any of these other things doesn't sound like that. So that kind of leads us to today and today's conversation, to where, we have a lot of influencers. So we have people on the referral side. So we have I have a traditional U.S. group that's raised their last hedge fund they raised for. They're a professional group of, they're all licensed guys down here in Florida, and all they do is raise money. I'm not sure if you know the U.S. hedge fund kind of demographics, but they've all moved out of Connecticut because they're in Boca. So Boca has become the capital of hedge funds for the U.S. And there's a lot of money down here on top of that. So they raised we have this group that raised about 85 million with their fund was seeded under $100,000. So an under $100,000 seeded fund, they raised $85 million in less than a year. And that's just using traditional sales guys. I'm not sure how much their subscription minimums were. I'd have to find that information out. I never really went that far. But that's one of the links that we're bringing to the team. Additionally, we have referrers. So we actually have people who are influencers out there in certain things. Like we have a contract right now with some people on the money team, which is Floyd Mayweather. We have this big fight happening here on Saturday, and they have very good relationships with both Floyd Mayweather Sr., both Floyd Mayweather Jr., and their brother. They all work together. So they have very good contacts on that. So we're actually looking to use these influencer models to, let's say, help the professional athletes who 85% of them go bankrupt 3 years after their $1 million contracts expire. So the goal of what we're trying to do, and the concept of this is an income for life type of fund, because it's, I don't believe that because again, we're trying to go non-traditional, yet we are going to have to use some traditional methods just because obviously they happen for a reason and they were proven for a reason, and the clients respond to psychologically to one way, and actually how they look at things another way. So we're looking to bring in influencers on one level. We're looking to bring in the traditional guys that sell to, let's say, go sit in Merrill Lynch, and they have a whole team of guys, and they're just selling to the local financial planners and local financial guys throughout the area and in different areas. And then we have another group that has the traditional, let's say, access to hundreds of millions of dollars. So 400, 500 million. So we have the, I guess, I don't know how you'd call her, but we have two different people that are on the basically capital raising, but they're on the rich family side of things. So they already have all those. Yeah, she's more of a she's more of a connector. So she connects the money with the funds and yada yada yada. So that's kind of where we're sitting with things, and what we're looking for, or where we'd probably you can talk more about this, and I want to hear from you and from Chris on your feelings of this. We're going to need somebody's to sit down, because I'm not the financial guy, and I'm not going to try to pretend like I am. I know enough to be dangerous. I've studied with Ron for the past 3 years about every single day. So I have a lot of, let's say, inherent and very a lot of gained knowledge over Ron's 20 years of experience. And we're basically in the process of just setting up a team to raise this money, put everything together, and make a shit ton of money off of it. That's the main goal. What we need is people to be able to sit down with the money people and get them to write a check.
Okay. Well, thanks for the background, Adam. I appreciate it. I can give you a quick rundown of my background and kind of tell you where I'm at and what I'm trying to achieve.
Please do.
So my entire career has been spent within one form or another, sort of asset management, private wealth management. I kind of went quite a traditional route, going through Ram Merchant Bank's training program, their graduation program, completing my honors in finance and then doing a CFA and then working at Goldman Sachs in London for a while. I have an EU passport. I dealt with the German and Swiss clients. And then, I saw good things happening in South Africa at that time. Around 2003, we were awarded the World Cup to host the World Cup. And there'd been a successful change in terms of the election. So I came back to SA knowing that there was, there was quite a bit of growth in emerging markets. And I joined a hedge fund locally, Peregrine Capital, where I understudied the MD there. And there was a construction boom. So my speciality was infrastructure and energy, commodities. And after 2 years with them, I left with one of the partners to start another hedge fund in Cape Town. We lasted about 18 months before we decided to split. And while I'd been working at Peregrine, I met my last partner who had listed his company, Ronnie Mazor, an Israeli guy. And he seeded me with 10 million rand, $1 million at that stage, and some working capital. And I built it up over 6 years to, $250 million fund, so 2.5 billion rand. And we were one of the best performing funds. On a 3-year view, we were the best in South Africa, net of fees, 38% compounded. And my evolution in terms of being more fundamental, bottom-up stock picking, and then combining it with macro thematic analysis. And over the last 2 years, I've started looking into sort of algorithmic trading, quantum mental models, that sort of thing, and which is kind of part of the conversation that me and Chris started talking about probably about 6 months ago, where we started saying, well, what are you up to, and so on. And for me going forward, I'm still positive on emerging markets, but I'm kind of bearish on South Africa at the moment. And I mean, I did road shows and presentations. I was invited to talk at the Barclays Cap Intro in New York twice as part of only 5 South African funds. And I've got a network in Europe. So I know how much capital there is in between the States and Europe. I mean, there's not a shortage of capital. There's a shortage of good managers. There's not a liquidity problem you have there. Here, it's the opposite. So I've been working on a product for the past sort of 2 years, which is a global thematic fund, which talks about what themes are, dominating for the next 5 to 10 years. You spoke about technology. So obviously we have, AI combining with the Internet of Things and robotics, how that's disintermediating industries, e-commerce. You see the big deals like, what Amazon's just bought on the whole food side. And then there's the other themes, which are, I understand because I've grown up in an EM sort of environment where I see markets starting to formalize. So we call it the bottom billions out of China and India. And as these people start formalizing, they're not going to have huge demand for, let's say, BMWs, but they will start buying more infants formula and hygiene products and so on. So there's that theme in terms of millennials, longevity, people living longer. And the third theme is kind of the world's biggest problems, the world's biggest challenges like energy and food and water. And they're also the world's biggest opportunities. So I've built this fund, and the two things that I've been trying to achieve is, one, obviously get the fund going because I had promises of capital and commitments that didn't come through. But also, two, I've realized that traditional asset management 101, like running a hedge fund by doing, like I said, macroeconomic analysis and then bottom-up stock picking, you're kind of always going to be in the middle of the pack. And when I came across what you guys are doing, where it's like, look, I want to be on the right side of the trade fundamentally. So let's say, just for argument's sake, you believe that, Google is going to dominate, which I believe they will do, and you want to be long Google. But there's also other ways, like this premium extraction strategy, this option premium extraction that you guys have built really like phenomenal software on, that you can generate a much higher rate of return with, and at the same time, lower volatility. So why I'm saying this, why I'm telling you this whole story is that if you want to raise money from an institutional background, or you want to raise money from very high net worth individuals or private wealth, you need a story that's consistent, and you need a product that's, what I'd say is, it's not too complicated. You don't want to be explaining to the likes of the money team or, some guy who's, let's say, built up like 7 car dealerships and is worth, $50 million. He doesn't really understand options. He doesn't understand option extraction. He doesn't understand the tech. Like, you're going to lose him, and he's going to think, no, this is a load of bullshit. This is smoke and mirrors. But if you can tell him a story around a fund that has these themes, it's like, look, these people in India are going to be buying more soap no matter what happens in the Middle East in terms of the civil war. And these people in, let's say, China are going to be, eating more protein as they become healthier and they move from the rural areas to the urban areas. Their diet will start becoming more protein based and this. And you have a story around why you're buying these things, and the story is consistent. And that is the core of the fund. But the core of that fund is never going to achieve more than like 12 to 15% per annum net of fees. And you'll have not a huge amount of volatility, but you'll have market-related volatility. Adding a level of option premium extraction on top and underneath that, we have, be it that you're writing covered calls, selling protective puts, etc. You can start generating a higher return with lower vol. And I think that's when you're going to start opening doors to the likes of, the Swiss private banks and the big institutional asset managers in the States like Lazard and BlackRock and State Street. So I think you've got to also decide what kind of business do you want to build. Understand what you went through with your parents. And I've gone through exactly the same thing with my mother at this point. My father left, when he passed away, he left us a lot of debt. My mother's been paying insurances and retirement annuities for 40 years. And basically she's dependent on me for support. Like the returns are worse than cash over 40 years because of the fees. So I know where you're coming from. And also, I ascribe to the same sort of Malcolm Gladwell thinking in terms of like, there's people that have different skill sets, be it they connectors or be it mavens or be it influencers. And I'm definitely not an influencer or a connector. My skill is managing money. Like that's all I really want to do. I'm really good at understanding macro trends, looking for the best company within that trend. Like right now you want to be, just for argument's sake, short, fossil fuels and anything like dirty energy, and you want to be long, let's say, robotics. And my skill is being able to identify that and also find the best company to be long and the worst company to be short. And I can sell that. I can put together a presentation and I can guide and I can pitch and explain to people what it is. But in terms of getting a seat at that table, that's like, I've got no real network or pull in places like the States or Europe or whatever. I have a network, but it's not the same.
We can arrange those meetings. So that's what my team is very good at, is getting the right people to the right tables. So we're essentially marketers, man. I mean, my main job, I'm not even the programmer. I have a programming team. My main job is marketing. So getting the money to the table and the right people, whether that is BlackRock or whether that is, I come from a TV background. So I have, Fox bought my last company. So I have a good relationship with the Fox family. Obviously there's a lot of people in that family. And, we have our fingers into a lot of things and getting the right people to the table. So, if you have to get a meeting with Rupert Murdoch or James, can that happen? Hell yes. You know what I mean? Can we get you meetings with, anybody basically anywhere? I would say yes. So can we get you the meeting with Mayweather? Yes. But it's going to be up to you. And Mayweather, it depends on his team. We also have Pacquiao. So one of our influencers is Pacquiao's cousin. And, some of these people are sophisticated. Some of these people aren't sophisticated. So it will be a broad gamut of people that, or let's say, different sources of money that we bring you. So we definitely can. We have influencers on our team and referrers on our team who have, 80 to 100 NFL players on their in their network of people that they talk to on a, let's say, weekly or monthly basis. So they're very close with these people. We can bring them together. It would require your participation and
100%.
And you to actually be there and be the, let's say, face of everything.
So I mean, that for me it's very much down my line of thinking, in that, like, my skill set is I can build a product, however, and you can kind of decide what kind of product you're looking to build in terms of being saleable. Do you want something that's, if you have a very high volatility product that gives you like 40-50% return per annum, most people are very scared of that because it just seems to be true.
Can I interject there? So my idea on that, and Chris, Mark, you guys kind of weigh in. So my idea on the actual product is a 1 and 100 product. Okay. So from the hedge fund side, where we do 1 and 100, where we do a 5-year at 10% guarantee. We do a 10-year at 12% guarantee, and a 15-year at 15% guarantee. Okay, so the clients will get paid first. They will be guaranteed their money, so to speak, and then whatever we make over that isn't their problem anymore. So, I think that's a lot of from my understanding and my friends that are in hedge funds and my friends that have lost money. I mean, I had people that lose. I have friends here that lost money with Madoff. I have people that lost money with some cats in Miami. As much money as you can make in hedge funds, you can lose. If we have the right strategy that we know we can do well, I don't know from the institutional side how a guarantee would go over. But with options essentially by design, you limit the upside, right?
Yeah. And you can manage the downside. So the same thing I think should apply to a hedge fund based on the same principles. We manage the upside. We're basically taking the option as the fund owners to where we're taking the option. Okay, here's the option. You get 10% and there's penalties for early withdrawal. And I think basically a 50, 45, 40, 35, 30, all the way down each year for early withdrawal penalties, we can very well manage the system. And 5 years in any type of historical, especially with options or especially with the market, regardless of how the market does, from our side, we may have a weaker, let's say we could have a weak 3-year possibility where our upside isn't as high as it could be. But it really could, that track record and that payout we'd have people flooding in, I believe. Yeah. The way that we would do it, Mark, would probably be like one of those, those traditional products we do in the banking around the structured notes. So guy comes in with $1 million, you prepay the insurance for the downside and the capital guarantee and basically give him a staggered return over a period of time with a guaranteed payout at the end. So he puts in $1 million, you're probably only going to be using 800,000 for the duration of the contract. 200 goes in as a put option to secure the entire amount. And at the end of the day, you basically take his capital and give it back to him at the end of 5 years with his return. The difference between what we would do and what the banks would do is usually on the bank structured note, they accumulate the annual profit and don't give it to the client until the end of the deal.
Yeah.
So it's a very delayed payoff for the client, but he's certain he's going to get his 5 or 6%. What we were thinking of was more, make the client's money first, but pay him 3 months in arrears or 6 months in arrears. So you're always ahead of the payment curve for the client, and you get that utilization of his surplus balances during the period of the contract. So the 1 in 100 is a really different kind of deal. Most clients are going to get the 2 in 20 model, which screws them over because they always want that share, and that high watermark keeps, going up. So it becomes a lot more difficult for the fund manager to actually make money as the strategy rolls out. So the longer the duration, the higher the performance risk for the fund manager. So doing a 1 in 100, the client goes in knowing what he's got to do, and it's purely a structured note. It's not necessarily anything else than like a preferred share or a debenture. He's not necessarily going to be buying the shares directly. He's taking sort of credit risk on the fund as opposed to direct equity risk in the stocks. And he's relying on the story really to make the money. So Adam, this is the thing that Mark and I were doing when I was still in South Africa, was we were looking at the themes and then cross-referencing the 380 odd stocks that are well positioned for these themes into the system to see what their sort of options history is like. So whether or not you would buy Tesla and keep it in an income bucket or a capital bucket. And you can interchange the stocks between the buckets depending on whether they're in the money or out of the money. And the sophistication that comes around that is really about the position sizing. Because what you want to be doing from a fund management perspective is controlling your downside risk. Your upside risk is all yours, right? There's no transfer to the client. But the downside is always that you're going to have one client, and Adam and I always say, Mark, no amount of strategy can solve stupid. And you often have the clients that are born young. And, even with a 50% penalty, there's always a risk that someone's going to have shit for brains and decide to take their money out. So what's really critical is the distribution of risk of early drawdown relative to money deployed in the market. Because we all know when shit hits the fan, things compound. So you'll end up having a real drawdown in capital, and then everyone wants their money, and you can an artificial run on the
I've been through it.
Yeah,
it's much easier managing into inflows than it is into redemptions.
Yeah.
I think you must just separate out. There's two different discussions. The one is what kind of product do you want to build? In terms of capital, raising capital, I find, or I can tell you from experience, that the more simple the product, the more traditional the product, the lower the margin. Obviously, like traditional long-only asset management will have, a very low margin, but it's much easier to raise capital. Then if you have a hedge fund, which is it's more complicated, but it's still quite easy to understand how the whole high watermark works. Only as you beat that, do you start drawing 20% performance fees. That's still very palatable, and guys will you tend to raise capital relatively easy. Having a guaranteed product, I think, is an excellent idea. I think you just need to be aware that you're going to have to, when I say lift up your skirt, you're going to have to explain to the more sophisticated, particularly institutional investors, how do you guarantee their product? Because like you spoke about the equity-linked note or the structured notes, where it's almost like a deposit and you buy some insurance and then you've got some index tracking and you get a certain percentage of the upside and you protect it down there and the bank makes its margin. That's more of a asset gathering exercise rather than a performance chasing exercise.
Yeah.
The second discussion is, what kind of product do you want to actually run? So regardless of what structure you put it in, whether it's traditional hedge fund or equity-linked note or a pref share, like all of those things, what kind of product do you actually want to run? Because do you want to run just a pure options type strategy, or do you want to have an actual fund that has, call it 60 long positions, 30 shorts, and then you're trading around those positions using option premium extraction to extract alpha, but at the same time your volatility is much lower. And when your prime broker, when you're investors, and they're entitled to see, sort of your underlying positions to an extent, you have to give disclosure in hindsight on a quarterly basis. They'll see that there's actually you're not just churning options. You actually have real companies underneath. You have a bet on tech. You're underweight banks. You're overweight, European real estate. Why are you doing this? And then option trading is something that is almost like you have a fundamental strategy and then you have a trading strategy. So I think that the two can work very, very well together. I've used it to great effect. But in South Africa, you're limited because the option market here is very liquid. You have maybe 5 stocks you can trade on. In the States, you have maybe 300 to 500. Yeah, that's the beauty. And also, we're very limited in terms of capital we can attract and raise here. Whereas, this is a product that you can raise capital with globally. It can trade globally. Obviously, you want to try and make it because your technology is geared more to the States than anywhere else. I think it could work on the top 100 liquid counters in the UK, Switzerland, Hong Kong, and Sydney. But besides that, and Frankfurt, I don't think it would work.
Not even worth it. There's enough volume in the US that we don't really need to probably go anywhere else.
Sure. 100%. 100%. So I think,
so to your question, to your remark on guarantee. So I think the best way to explain guarantee is, well, it's not a guarantee. It's that we're giving the client the first 10%. So we're making sure you get paid. Okay. So that's the feel good aspect of it, right? Because as soon as you say guarantee, red flags go off anywhere. So we don't even sell it as a guarantee. We sell it as a 10%. And you get the first 10%. We don't take any fees. We don't take anything. There's nothing above it. It's just you get the 0 to 10%. Once it hits the 10%, then that's where you're capped at. So it's more of a cap than it is a guarantee. So, I mean, of course, if the shit hit the fan and everything went to 0 and there's no trading going on and the market crashed, we can't guarantee someone 10%, right? So to give a quote-unquote guarantee, it should be a cap. So they're capped just like in options. You're at a cap. So, if all goes well, sure, it's a guarantee. But when you speak to, like you said, anybody, they're gonna red flags gonna go off. Oh my God, he's giving a guarantee. How can he give a guarantee when no one else can? It's
like a Bernie Madoff trade. That's the worry.
Well, the thing about Bernie Madoff was he didn't make the trades.
No,
So,
it was a
yeah,
Ponzi scheme.
if he would have actually made the trades, he would have done really well. I mean, he was only promising, I think, 1%, very similar to our promise. Yeah.
It was 1% a month. In fact, if Bernie Madoff did do the trades as he said he would done, he would have beaten every single index and fund known to man. But he lied and he took the money.
It's so stupid.
It's
So
crazy.
we want to just have transparency, give them a cap to where they can see things where things are going, but not be too transparent that they start freaking out. You know what I mean? Because the more information, a lot of times, whether it's a sophisticated investor, even on the institutional side, if it's someone's pension fund, and however it is, these are all personalities, Mark and Chris. So there's going to be one person at that pension fund that says, oh my God, like we had a guy the other day liquidate his account because he had went through the Korean War prior, in his lifetime. So the stress from the first Korean War, maybe he, had some post-traumatic stress syndrome, just hearing some things on the news about, Korea having nuclear weapons, which who gives a shit if they do. But it freaked him out enough to do something like that. So we always have to remember that in everything we do here, even when they're institutions, there's always a personality involved in these types of things. So we have to be very careful of how the actual product, like you said, is structured. So what's actually behind that product. And, I guess a lot of these multi-strategies, I think a multi-strategy is going to be the best possible thing to say.
Definitely.
Because then you don't have to get super specific. And a lot of these funds just sell multi-strategy. Yeah, it's a multi-strategy based on options. And then we don't really have to get into how we do what or why. Because once you get into it, I've been doing it for, 4 years every single day for about 10 hours a day. That's including weekends. And sometimes shit still goes over my head, and all of us, because there's it's very challenging to explain it to somebody who doesn't get it. And it's very difficult to get it. I didn't get it for the first year at all. Like the first year I was like, just kind of watching. And then finally one day it just clicked and, I get how it works. But we don't have that time with these customers. We need to get them in and out really quick. And,
I think complexity, to be honest with you, Adam, what I've noticed is complexity is definitely the enemy of execution.
Absolutely.
If you make it complex and you kind of, like I said, if you lift up your skirt and show them exactly how things are made and how this trading, they don't really care how the algorithms work. They don't really care how I would pick stocks or how I would construct a fund. They're not really all that interested. They might sound interested, but it's like kind of, when you buy a new car, the mechanic's sitting with you and trying to explain every bit of how the engine works. It's like, look, you want to know that it works, it drives, it's not going to break down. That's what you care about. And that's what you need to also keep, you literally have, in my experience, and also having presented, quite a few times over the past decade, the fund, the strategy, and it hasn't really ever changed. It's just evolved and become more streamlined. I know you have 20 minutes. That's it. You got to get in there, establish rapport, and you got to, every person's different. Some guys that you speak to on the institutional side are a bit more dry, and they're more have accounting, finance, actuary backgrounds, and you can really get into the detail. The majority of people in the private wealth space are like, look, if I give you money and you screw it up, I lose my job. So they just want to make sure they can trust you, and they want to make sure that you're not just, you have there's a bit of brains behind what you're saying.
Exactly.
So I think you can tailor. I think you guys need to figure out, I think that product sounds brilliant. And if you guys are happy to, for me, I can tell you, I can structure a traditional hedge fund, Cayman Islands, offshore jurisdiction, that sort of thing. Those guaranteed types products, even though it's not guaranteed, even though it's like an equity linked note, I've never actually put one together before, but I'm more than willing to try and, help and figure out how it works and do the legwork. What my skill is, like I said, is I'm really good at managing money. So I'm really good. If you give us cash, I'm really good at making that cash work and understanding why I'm kind of short precious metals at the moment versus long, overall resources and blah, blah. And I can give you a whole story. It's all for hours around that. And it's like thematic investing and why I like interactive or electronic arts and Activision, and why gaming is becoming so popular in Tencent. I can give you theses on these things. And that's where I think, like, I'm hoping that I'll come across with enough credibility to potential offshore investors. I had success in raising capital from guys in the UK and the States, but at the same time, there's never going to be much appetite for like just a South African domiciled fund. You're very limited.
Yeah.
Emerging market fund, a lot more. But if you have a global thematic fund, it's like you're unlimited in what you can trade. And you say multi-strat. The most important thing in running a hedge product is you don't want to be restricted, because restrictions can actually become like an anchor, and it actually inhibits you from executing your strategy. But at the same time, you don't want to be able to, you want to make sure you're limiting, like Chris said, you want to limit your downside and kind of keep your upside options open in terms of gearing so you can make that payday.
Yeah. No, I worked for a venture capital firm, and we actually helped a hedge fund about 10 years ago, and it was fully thematic. I think it was something about it was just about everything was just online e-commerce, and they did like an online e-commerce type of fund where it was just different things in e-commerce, a lot in Amazon and a lot, they would have done really well, obviously.
In the last 6 months.
They started with Amazon. So I think he did really well. I left that company after like a year. But yeah, I get that side of things. I think that we could probably put something together really well with that. So, I mean, I think as long as we have the good materials for the marketing side, as long as the story correlates, and as long as we can put you at the table with the right amount of people, at the end of the day, Mark, it really doesn't matter. If we can put you in front of enough people, we're going to get whatever we want.
100%.
So the goal is to get to $1 billion in the fund. That's the goal.
I agree with you. Great goal. The starting marker. So we're probably we're gonna work on seeding it with about $1 million. That will give us a 6 month to 1 year track record that we can actually go out and sell with, because the track records that we have are, they're skewed and they're not actually on this exact product. So, we can always put the cart before the horse, so we can start selling things before things are all set up anyways. I've done it. It's not an issue on that side. So we can kind of set those things up as we go. We have some existing internal clients that we may be able to switch over. We have some other relationships that we're going to be bringing in. So we have a couple million waiting in the wings to seed it. We just need to really, from there, get the track record for a couple months. 6, I think, is probably going to be the minimum. And then from 6 to 12, we just start setting up as many money meetings as possible. And hopefully what happens is during that 6 month time period that we have a huge market crash this year. I'm totally serious. Like I really want to get that out of the way, because Chris, you know the Cedric chart, right?
Yeah, absolutely.
So the Cedric chart, I don't know if you've ever seen it, Mark. I think I have it on my wall. 1 second. Let me grab it. No, I took it off my wall and moved it somewhere. But this Cedric chart goes back like 150 years. And we thought that maybe Trump was going to change the Cedric. But it's looking like with Cedric kicking in, we are going to have some type of downturn. And everybody kind of thinks that's going to happen. So we're kind of planning for that.
But Cedric is in like the name, Cedric.
Cedric, yeah. It's here in the book somewhere.
So, Mark, effectively what it means is that there's an extended cyclical behavior to the market. Yeah. And the chart becomes quite an ominous forecast. It starts looking at, where we are relative to the S&P. And Ron, Ron's pretty much been on the money, eh?
Yeah, it's not Ron. This chart, Ron found it. The chart goes back to like 1800, or even before that. I know. Anyways, it goes back a couple hundred years. Ron's reprogrammed the math to go out in time to, where we're at right now, and it's predicted every single market crash in the history of the stock market for over 100 years.
And when's the next one?
We're sitting on it.
Which should be now.
Yeah. It's now. And a lot of things are pointing to that.
wouldn't argue with that. I'll be honest with you. I mean, there's been this huge wave of optimism on the back of promises by Trump that haven't come through. There's a lot of geopolitical risk at the moment.
Right. Yeah.
And,
and it takes one event to have a 50% drop. And the market is really, really over leveraged. So the prices are bullshit. We know that. They're 10% above where they should be. So a 50% market crash, and then we build back to normal prices. The chart actually goes up to 2025 from the bottom, which is 2019. So 2016 to 2019, 19 is the very, very, very bottom. But that means we're in the best time. And that's where we're going to actually get the most money. So when things start crashing, when other hedge funds start making mistakes, so between 2018, which is this year, and 2019, if things go as planned and we do have that, let's say, catastrophic event, we've got 9 years of up.
Yeah.
That's all we need is those 9 years. I mean, screw anything else. So I think timing-wise, it's the perfect time to really put a good plan together, put a good structure together, and then we're going to have people scrambling in 19, like, what the hell do I do? Because real estate is going to tumble at the same time the stocks do. So if we have a good plan for actually – because that's when, like, online. So I told you I'm a marketer, right? So most people, like, there's health problems, there's wealth problems, and then there's relationship problems. Those three things cover every single problem that all humans have. And if you sell to those, so everybody's going to have a wealth problem when this comes, okay? Everybody, they're all going to look for help. So that's where we're going to have to come in from the help standpoint and kind of stand back and educate a little bit and help people a little bit. And it doesn't hurt to, put these things out on paper now that we call it, hey, let's put it on my blog on LinkedIn. The market's crashing, guys. The market's crashing. Even if you're wrong, it doesn't matter. You can always go back in the story and say, look, I predicted the crash based on this Cedric chart. Look how smart of a guy I am. So you have to use those things for your future sell now. Even if it doesn't happen, you just never tell anybody that. But if you put it in your sale now and say, hey, the market's crashing. I've been following this really smart guy, Ron Groenke. Ron Groenke came up with this chart, and he did the math out. And I'm telling you, this is going to happen. Who cares if it doesn't? Just put a blog out there, and then you can go and send that blog to the New York Times in 2 years and say, everybody that needs the help, we have the solution because we knew this was happening. We've been planning for it. Those types of sales things, because this whole thing is just one sales pitch. I mean, at the end of the day, if we cap where the money is going to be given out at, we cap the upside. It's our problem how well we do. I mean, that's the main thing is like, that's my biggest concern is the upside.
And also, if you think about how we've worked, Adam, the upside is definitely under our control. The thing is, because of the way in which the system generates the opportunities, we can set that upside.
Yeah.
So we don't have any upside risk in terms of non-performance.
And we have margin control. So I mean,
it's really risk management, and it's keeping the story consistent. That's the challenge, because I know how complicated this is, and I'm not as smart as some of the other guys, but if you don't keep the story consistent and you don't have a well-structured theme-based story, people tend not to believe that you can do it.
That's been our problem. This 1% a week. Nobody believes 1% a week. We can show them the numbers, and they say, I don't believe you. You made those numbers afterwards. We're like, well, these are the real numbers. We didn't make them afterwards. They're in real time. We publish them. Follow us for a month. You'll see every number we publish is real. But the problem is people don't want that number. They want 1% a month. And that's where this 10%, 12%, and 15% are perfect. It's my grandfather. I don't know, Mark. Do you know the Great Lakes in Ohio and Michigan?
Yeah.
Well, my grandfather built the break wall with a backhoe. So he's just an old German guy with a bugger or whatever you call it. Is that what you guys call it in South Africa? A bugger?
Digger. Yeah, digger. But yeah, it's digger.
A bugger has a completely different connotation. If he built it with a bugger, then we have a problem.
We got a problem. Okay. So he built it, And I guess he died a couple years ago at like 90. But when he built it in his 40s, and he retired at 42, right around my age. And he took $2 million and he sold his company because he had the big contract. He made a lot of money. He sold the company for $2 million. Then he took the money to the Cayman Islands at that time, and Cayman Islands banks were giving 10%. 10%. Nice, huh? So he told me, he sat me down here at Marco Island in my house, said, Adam, whatever you do, just find some place you can just get 10%. You'll live happily for the rest of your life. You don't have to do anything. He didn't work a day in his life over 40. He hunted, he fished, he traveled, he did whatever the hell he wanted on his own schedule, on his own timetable, and he never worked for money again. So I think with that kind of thinking, that's kind of where I came up with this product as well. Like, man, all you really need, like 5 years and 10%, like keep rolling it. You know, if you're happy after the 5, you let them roll at the 5. I mean, we'll say, okay, you only want 5-year commitment, no problem. Only get 10%. Those that want the longer commitment, they get a bigger percent. And then after the 5 years, they're going to roll it another 5. Nobody's going to pull out getting a 10% at all. You know, well, I can get more over at this fund, but you can lose more over at that fund too. But if we have a 5-year track record of giving 10%, I mean, how many billion will they throw at us? A lot.
I agree 100%. I think the nice thing about it is that the liquidity and the upside is unlimited, you know, and I completely agree. You want to build something, you know, running a hedge fund, you kind of on a treadmill. It's a daily grind. And, you know, like, I mean, for an argument's sake, simple example, last week, the end of last month, I was up like nearly 4%. That afternoon, the day before month end, the FDA comes out and says they want to, you know, reduce nicotine content in cigarettes to almost negligible amounts. The equity gets cracked down like 8%, 10%. I had 2 big bets on British American Tobacco and Reynolds, and you're down sort of, you know, you lose half your performance for the month. It comes back the next month, but you're always kind of,
because they bought all the marijuana, so they've actually, you know, the Reynolds Corporation has bought all the. They're going inquiring the small marijuana growers where it's legal, and they're poised to get into that business. Huge,
great business.
Yeah, I mean, it's the thing is it's still illegal here in the U.S. and it's illegal by UN. So there's a UN agreement that we're not really allowed to even make it legal. So you know, it's going to cause some riffles if they actually end up trying to do it. But, you know, and even on that tobacco thing, the nicotine it's ridiculous because the what's addictive in cigarettes is actually sugar. And in the US, they don't have to list the sugar content.
Yeah. Now, look, I mean, the idea going forward for me is the same as what you're talking about, is you want to build a product where, and I don't want to say it's automated because nothing's ever automated in life. You need to actually put in the effort.
We can talk about that as well. So there is a very big portion of things that we can automate. Okay. The time frame that will take, we'll have to do some things manually. I do have, you know, an idea of how exactly to do that. But my goal is to make, let's say, your and Chris's job to be the face and to be the quote unquote senior partners, you know, manager guy that you go and you speak to everybody and try to keep your daily problems to a minimum. So I believe that we can even handle, you know, what's not automated can be handled by the existing team that we have, and really just effectively put things into place where you're not so focused on strategy. Your strategy is how am I going to get the next million? How am I going to get the next 3 million? And how's that conversation going to go? Because that, I have to say, like, for you to do a lot of things, you know, I don't think that's as effective as just being the guy, the nice, pretty face, Chris, Mark, you're beautiful guys, you got nice beards, and, you know, you're all all Mr. Sexies, and you got the right resume that we can put it forward and say, okay, these guys have done it before. Mark has a good track record. Chris has worked at this bank, and this hedge fund. And, you know, you can go into any meeting with confidence that the program and the back office that's running things, that's actually working out the trades, based on a let's say a mutually agreeable, let's say, platform and a product that we can all sell, makes a ton of sense. To where the day-to-days, I would probably say, your day-to-day should be worrying about where you're flying to next and who you're talking to next. So what's your family situation like, Mark?
Good. We have 2 and one on the way. So
Okay.
I've got a daughter of 5, a son of going on 3, and my wife's due next year in March.
Okay, super.
Yeah, so it's all good.
What's your wife's feeling? So what's the plans for like global participation? Because obviously there's a lot of money in the Middle East. We have a lot of connections in the Middle East. We have a lot of connections in Europe as well. So a little background about me. I told you I was in the TV business. One of my main investors was Joop van Ende. Joop van Ende is the one half of Endemol. So he sold his company Endemol, which was, remember that show Big Brother?
Yeah.
He sold that show. They sold that for $5.5 billion to Telefonica.
Sure.
So the business development friend of mine who brought me over, we ended up getting screwed in the venture deal we did with them for whatever reason. But my partner, who was the guy that brought me in, is still there on the venture side. And now he's at the top level of all the venture money, to where he even controls that fund. So I showed him Wall Street Winning, and he said, "Oh man, I can't sell this. It's too hot. It's too Las Vegas. It's too shiny and bright." And I didn't have the right product. So we have that infrastructure there for Europe. So we have a lot of that Dutch money, and that Dutch money is, controls a lot of European money. And, and same thing with UK. So we also had a couple Bear Stearns guys on the team, and, it's not a challenge for us to set those up. And then on the US side, like I said, we have that not even sophisticated money. We have the stupid money, like the NFL money and boxing money, and, just the stupid money. We have stupid American money that we can put
I have a network having worked in London and having dealt with a lot of the German and Swiss clients having a German passport. A lot of the guys I work with. Sorry?
And he's a German passport.
Fluent German as well.
My father's German. He was born in Hamburg. So I'm German. Cool. Yeah.
I lived in Germany for 3 years.
Whereabouts?
In New Brandenburg.
Okay.
In Neustrelitz. So my daughter is still in Dresden. So I have a 13-year-old daughter in Dresden. Okay. So I'm planning on heading over there for kind of an extended stay for a little while, to stay closer to her for a little bit. And that's awesome.
It's a great country. It takes a while to get into it, but they're very, like, once you make friends with Germans, they tend to be friends for life.
As long as you don't have an American passport.
No, they're fine with American.
It depends what side you're on. If you're on the east side, it's not so fond of Americans. Like my best friend in East Germany was an Iraqi. Now the West Germans, that's a whole different type of German. But where I lived was the highest concentration of Nazis pre-war. And they didn't die. They just had kids and had families and and they changed their names to socialists. Yeah.
You must go to Munich. Go to Munich. You'll love it.
No. I've been to every city in Germany. My ex-wife was a spa hotel tester. So I went with her and I tested every 5-star spa hotel in Germany. And I stayed in the hotels and I got massages. Oh, it was a great couple of years.
It sounds like the kind of job I need next after I quit managing money.
Right. Well, I think that should be kind of more your job, really, to test the spa hotels. And then when you're at the spa hotel, you have a meeting with X, Y, and Z. So I also have a very good connection. He's a former partner of mine in Indonesia. And the top, let's say over the next 10 years, China's number 1, US is number 2. I think Indonesia is like number 3 or 4 in GDP. So he's in the defense department there in Indonesia. And, having some conversations like that, he's definitely, how Indonesians are. They're all go-getters. I mean, you throw them a little money, they'll, they'll get you $1 trillion. So they'll get you the whole budget of Indonesia. But, you know, those kind of things, we're going to need somebody on the ground in those places, flying around and having those meetings and being in that spa hotel. Having you in an office in South Africa managing a fund, it's not going to be I don't see that as being the value. I think the value prop is actually having your face on the ground, attending the right meetings with the right resume, and you roll out your resume, you roll out your past history, and you roll out the products and say, hey, sign on the dotted line.
I'm happy to put together. I mean, I'll put together proper presentations. You know, really slick, automated. I can, you know, go through one or two with you. If you've got a gap, I can send them to you. You know, properly automated, done in Keynote and on the Mac side. You know, like there's no words. It's just kind of all visuals, going through things, explaining the themes, explaining the strategy. Like all the boxes that I know need to be ticked when someone's doing a due diligence, like operational side, your research side, your portfolio construction and risk management, how it all ties together. Like you know, that's been kind of what I've been focused on for the past, call it decade, since I started the business in 2009.
Okay.
So that's none of that's too much of like that's what I'm confident on. The stuff that I'm a little bit not concerned, but I think you guys need to maybe take a bit more time on is the product structuring.
Yep.
Like the regulatory issues around the product structuring and that sort of stuff. You need lawyers for that, to be honest with you.
We have a good SEC attorney now, and her name is Laura Holmes, and she's beautiful. No, it's really helpful in the United States to have a beautiful woman attorney, because they can do things, especially in the financial world, that other people can't do, because you know the financial world. Okay.
Yeah.
So that's why I went for a woman. She's really smart. She's based in both Palm Beach and Naples over here, so she goes back and forth. So she's right in the hub of it. She already represents quite a few funds over there. So she'll be doing some introductions on top of whatever type of legal wrangling needs to be done.
And I have a network, like I said, having worked with Goldman, like the guys that I worked with, one of the guys that I worked with there is one of my best mates, is now, he heads up Julius Bayer's private wealth for Eastern Europe. Nice. Another one of the guys, Marcus Grimm, that I work with, works at Nordstein in Switzerland, a private bank there. Then there's Pictet. I've got guarantees of around $5 million once a product is set up. One of the guys I did marketing with and for me is a guy called Thomas Venman, who's also German, but he lives in Switzerland now. Very much a cliched life of, you know, the house on the lake in Zurich, young Swiss girlfriend. He works for the Porsche Instructors Club now. He collects cars. Yeah. He used to run Merrill's private wealth desk in Zurich, and he's about 65, 66. He doesn't want to work too hard. His best friend, or the guy he travels with the most, is Josef Ackermann, who's the ex-CEO of Deutsche Bank. So there's leverage there. He said he's not willing to put his name or face to something until it's been going for a certain extent, and he'll put his own money in. And so he had money with me in the past, and it's kind of like something that I've got those networks, but we just need a decent product and a decent story. And once you put the two together and you've got a bit of a track record, like I've seen the J curve, I've seen how it goes, where it's the first year, 2 years, people are they give a bit of money, but they're skeptical. When you hit the 3 years, things start taking off. And by the time you get to 5 years, you can almost, when I say stop marketing, it's just like you're well known, you're winning awards, you've got the longevity, so on and so forth. If your story stayed consistent, you haven't gone from being global macro to being actually, no, we stock pickers, actually, no, we're like a commodity fund, then people don't like it, because what's on the box must be what's inside the box. You know, what's on the cover of the tin, they want to know what's inside, because for them, they're often blending you with other strategies, especially on the institutional side. They're saying, you're this multi-strat, we've got a fixed income guy, we've got a pure bank guy, we've got Chase Coleman, who just does tech stocks, and then they can put it all together. When you start deviating from that, when you have style drift, like they don't mind if you have a drawdown. Performance is not what loses you money. It's having style drift and having operational issues. So most hedge funds don't close because their performance is bad. Most close because they have breakdowns in operational kind of efficiency, and that creates tax issues. And that's the last thing that any ultra high net worth individual wants. Like the two things those guys are the most scared of is like obviously having poverty and destitute, but tax terrifies those guys because they just see, you know, in their game, they're always looking for a quick buck, a quick shortcut. Money's come easy, and the tax is often what trips them up. So you got to just make sure the product's robust. The rest of it will take care of itself. I can handle the performance and the story around it and the presentations and all that.
This is why one of the things that attracted us to the fund was more around those particular issues, because a lot of the clients, when they do it in their own name, transfer their own problems to us.
Exactly.
And it starts impacting. So when Adam was mentioning that guy who lived through the Korean War, mentally, he wasn't set up initially the right way to actually face the strategy head on. He was trying to use the strategy for what it wasn't designed for, in a structure that wasn't appropriate. And through that, he almost tripled or quadrupled his own sense of risk when there wasn't any. He manifested his own issues in his head. So, the thing that I've always said is an issue is your reporting has to be accurate.
100%.
You can't be reporting, on one basis but trading on another. There has to be a consistent ability to produce those numbers. It doesn't matter about the timing of your reporting. You could always report in arrears. There's no reason why you can't do delayed reporting. And sometimes less is more when it comes to that. But Mark's point on style drift is really important, because in options, if you approach a pure option-based strategy, you've got 370 different ways you can make money out of options. Now, the thing that we do is there's a very, very specific method on how the system works and how it generates trades. That's consistent. That's not going to change. You're not going to see suddenly iron condor trades start coming up and butterfly spreads and all of the exotic stuff. Because that's also where hedge funds fall over, is there's a misperception about individual trade risk. So often you have inexperienced people taking very sophisticated trades, applying them, and then wondering why they lost money. Adam, that we had one of those guys in Texas who was very much like that. He started to believe his own intelligence, and that's where a lot of funds fall over, is the arrogance in terms of how they've approached the market. And
the thing that I just say, just to, like the final point I'd add on that, is that if you want to attract, proper institutional money from family offices, like we had Duration, which manages Al Gore's money in London, and we've had Erstelan in Switzerland, which had a lot of money from the Middle East. Like, the guys also want to see, when I say operational robustness, they want to know that, like, your auditors are, one of the big five. They want to see that your custodian is a decent bank. They want to see that you're prime broking eventually with, and that's another discussion, because that's only once a fund starts getting to a proper size. But you also want to understand that, if you want to raise proper money, there's like what they call an Auburn report. And in order to pass this Auburn report, it's like a $200,000 report. And I was going to be the first hedge fund in South Africa that passed this report, because I'd actually gotten hold of a copy on the other funds that they'd done and figured out where they went wrong. And one of them was that Peregrine wasn't a suitable prime broker. Another one was that Nedbank wasn't a suitable custodian. So we were onboarding with Credit Suisse and setting up with State Street and whatnot, and Bank of New York Mellon. And once you've got that report, it's like having an opening introductory letter from, like, the president. You just walk into a door and you put the report down and say, we've passed this report. It's like their due diligence is done. It takes a huge headache off their hands, and they can hold it up and say, when was this report updated? There's another report called the Association of Alternative Investment Management Association, which you pay for. But that's you fill in that report, rather than these guys send a team out to do it. So once you get that kind of operational robustness, it's like the doors really begin to open, because most big institutions won't talk to you until you've got a 3-year track record or 100 million, usually both. And with that Auburn report, along with a 3-year track record and 100 million under management, and your performance has been consistent, you haven't been up 12 or down 12 in 1 month, because that's what terrifies them, is the volatility. I promise you that, like, the raising of capital and the generating of wealth won't be the problem. It'll be how to contain the operational robustness, because your complexity from 1 to 100 clients is not 1 to 100. It's 1 to like 1,000. It's exponential. That's what tripped me up in the past. It wasn't performance, and it wasn't raising capital. So just bear these things in mind. And, like, these are things that I know I know when we'll need to pull the trigger. It's like, you got to look where the ball's going to be. Like, I'll know once we start getting to a certain point where I can see operationally the kind of clients, the questions they're asking us are no longer, like you say, the foolish money. It's like serious money. It's like guys like Arkham out of Dubai that have got, $1 billion multi-strat fund that say, let's see your AIMER due diligence. Let's see you mind if your auditors send us your audited fund returns on a daily basis. We want to run the performance and the vol on a daily basis and net and gross exposures through our model. Like, if those guys allocate, they don't write tickets for less than $100. And like, they don't mind paying the fees. They don't come and fight with you on like 1 and 20 or 2 and 20. They're like, could care less. So let's think about both. Like, I agree with you that captured kind of guaranteed product is really brilliant. I think you should look at potentially having a simple structure that can have normal hedge fund flows into it, because I do know that there's tons of money out there, and active is making it. Was swinging from active to passive for a while, and now it's swinging back to active. You know, I get the feeling the hedge fund industry is continuing to see inflows, just not emerging markets as much as they would like.
Yeah.
Well, that's good, and we do have time for that. So that's the good point of all that comes with your experience, and we don't have to have all of those things on day one. So that is
100%.
That's not an issue. All right. Well, that was great to meet you, Mark. It was really
good meeting you too, Adam.
Thanks, Mark.
I appreciate it.
Thanks, guys. You let me know what you need from me, and then you let me know what you guys think is the way forward, and we'll go from there. I'm happy to set up another call whenever suits.
Sure thing, buddy.
Absolutely.
Take care.
Thank you very much.
Get in there, Chris. It's getting there.
It's coming, man. It's coming.
Slowly.
Take care,
Cheers,
buddy.
guys. Take care. Have a good weekend.
Cheers, eh?
Ciao. Bye.
Bye.